in New York City, Thomas J. Hayes, Chairman and Managing Member, Great Hill Capital, LLC. Hello, Thomas. How are you?
Doing great. Great to be with you, Maria.
Okay, well, the Fed raised interest rates by 25 BPS as expected by the market. The Fed also noted that inflation has eased but remains high. Does this mean inflation has passed its peak and is on track to drop to the 2% level the Fed wanted?
Yeah, well, what we know is inflation peaked in June, Maria, and the latest year-on-year change in core PCE was just 4.4%. If you look at the hike yesterday, that takes our Fed funds rate from 4.5 to 4.75%, which is now above core PCE inflation. Historically, every time the Fed funds rate got above core PCE inflation, inflation was crushed. It dropped like a rock. So I think that's where we are right now. The Fed now has justification to pause if they want to in the March meeting. The market tends to think that they're going to go one more 25 basis point hike, but we'll see. The key is that inflation expectations have collapsed. They were 3.59% last March. They're 2.29% today. And for the first time, Chair Powell, acknowledge that we are in a disinflationary environment and that we really see goods prices coming down. So it was nice to see that from Chairman Powell.
Okay, that's so interesting. What are the odds of the Fed raising interest rates at the next meeting this year? Or still hawkish or dovish?
Yeah, so Maria, right now, if you look at the Fed funds futures, they are pricing in an 82.7% chance of a 25 basis point hike in the March meeting and a 17.3% chance that they're done and there will be no more hikes. This is going to be data dependent. We have two more jobs reports before the March Fed meeting. We have one coming up on Friday, which is a very, very important data point, and one the first Friday of the following month. The other thing that we're going to see over the next month is going to be a lot of inflation data. So this is going to impact the Fed's decision moving forward. So right now the odds are on one more 25 basis point hike and we're done, but that's not guaranteed by any stretch of the imagination. The other thing to keep in mind is Chair Powell said it's certainly possible that the Fed will keep its benchmark rate below 5% when CNBC U.S. reporter Steve Leisman asked him if it was possible that the Fed funds rate could stop below 5%. So it's kind of up in the air at this point, but it was good to see the flexibility on behalf of Chairman Powell yesterday versus the very hawkish version we got in Jackson Hole over the summer.
Okay. In terms of the conditions that the Fed raised the interest rate until 25 BPS, what are the 2 days investors looking for? Still in the safer stock or see another opportunity stocks like bonds?
Yeah, so I think what we think is the great opportunity here after such a sell-off last year is to buy high-quality stocks, high-quality companies that have been marked down, that are productive assets, that generate cash flow. And we think there's a tremendous amount of opportunity, particularly in the emerging markets. Now that the U.S. dollar has come down about 11-12% in the last few months, you're seeing emerging markets start to rally, and markets like China really getting a boost, particularly their platform companies, because the Chinese government has now decided the stimulus is not going to be housing related, it's going to be consumption related, and companies like Alibaba are the toll takers in that type of economy with that type of initiative from the government. So we think that's the opportunity moving forward, is to be in high quality companies after they've been marked down.
Okay, that's so interesting to see the opportunity the capitals comes to another country. How is the flow of the foreign capital, especially to emerging market countries such as Indonesia? Is the time too high in the condition of U.S. interest rates?
Yeah, I think this is a big opportunity. I think this is the biggest opportunity of the next 2 years. What the dollar weakening is signaling is the Fed tightening cycle is over. And despite the 28% move of emerging markets index off the lows, it's still trading around 2007 levels, over 15 years ago, never mind all the growth in GDP. And the last few times that this happened, was 4 times since 2000. The dollar weakened in 2002. From 2002 to 2007, emerging markets rallied 480%. Happened again in 2009. The emerging markets rallied 189% in 2 years. In 2016, the dollar weakened. Emerging markets rallied 96%. And finally, in 2020, dollar weakened, emerging markets rallied 97%. So we think that's going to happen right now. And we think there's a long runway over the next year or 2 years for emerging market equities.
Okay. On the other side, do you see that is gold still a safe haven right now? We know that gold reached its highest price in the last 9 months. At the same time, dollar index is decreasing. Do you see that is gold still being a safe haven?
Gold is historically a safe haven if you want to preserve your purchasing power. So, for instance, 1 bar of gold could buy the same suit in 1960 that it could buy today in 2023. However, we don't think it's the best inflation hedge. We think that companies with strong moats, with pricing power, productive assets, are the best moat. So, for instance, if you buy Coca-Cola Company, every year they can raise the price of their formula that they give to McDonald's and they give to all the restaurants greater than the pace of inflation. So we like businesses like that have pricing power, that have moats, and they're much better hedges against inflation. You'll get more appreciation, you'll get more dividends than just holding it in an inert, non-productive asset like gold.
Okay, and now, how do you see the strength of rupiahs and other countries in the Asian regions amidst the still strong in dollar index?
Yeah, I think the dollar index is going to continue its downward trend. I do think that the emerging market currencies, including the rupiah, is going to appreciate against the U.S. dollar. So you should see continued strength in the rupiah relative to the U.S. dollar. And that's going to be an opportunity. You're going to see more and more capital flows into the emerging markets in the next year or 2 years. That will strengthen the currency, but it's also going to strengthen the equity markets. So we think that's an opportunity moving forward. As far as Indonesia, fantastic demographics. You have a young, educated population. You have a strong balance sheet, only 41% debt to GDP, third largest democracy. So we like Indonesia as well.
Okay, well, thank you, Thomas Hayes, for the dialogue and also with the deep insights. Have a nice day to you. Thank you.
Thanks so much.